Welcome to College Cash Corner, the podcast where our goal is to help students navigate the world of personal finance. I'm Tara, your host, and joining me today are my co-hosts, Natalia and Victor. We are going to explore some of the different types of asset-backed investments out there that you can purchase once you have an investment account set up. In the last episode of College Cash Corner, we talked about common types of investment accounts, and that episode is titled Savings Superpowers, Understanding the Magic of Investment Accounts. So check it out if you're not aware of the different types of investment accounts. So like I said, today we're going to be focused on types of investments that you can purchase. So Victor, Natalia, question for the two of you. When you think of types of investments, what are the first couple that come to your mind?
ETFs and stocks.
I think of the most basic ones like stocks and bonds.
So today we're going to talk about stocks, bonds, mutual funds, ETFs or exchange traded funds, and annuities. So we'll start with stocks. Oftentimes when people think of types of investments, they think of stocks, right? That's what you hear about in the stock market. Victor or Natalia, have you ever purchased stocks before?
No, never, but close friends, they have done it. So I kind of know the excitement of selling and buying and how it looks in a platform.
Okay. How about you, Victor?
Yeah, the same as Natalia. I haven't really done it because I don't know. I just don't like losing, But I've seen friends do it and they've won, their fair amount of shares, but they also lost a good amount.
Stocks, what are they?
It's like buying a small piece of a company.
For example, if you buy 10 shares of a company's stock, you now own a tiny part of that company. So when the company is doing really well and making profits, then your stock or stocks in that company are going to climb. But if they're not doing so hot, that's when you see that start to decline. When you purchase stocks for their company, they will give shareholders a share of their profits. Those are called dividends, and then those add also to your earnings. Victor, do you want to go over things that people need to be aware of when they're choosing to invest in stocks?
So some things you have to be aware of, listeners, is that the value of stocks can go up and down a lot, which means that you might not always make money. You could even lose it some. Just like how I mentioned with my friends, they have lost many times, they have won many times. Another thing is that investing in stocks is for long term, not short term. Some people, they want to make some quick cash. That's not the way to think about it. Next is you got to spread out your investments and not pull out your money in just one or two stocks. This is called diversifying your portfolio, basically putting your money into different stocks to be safe. So it's important to be patient and not panic when you see your investments, go down or they don't increase that much. But in the long run, it will gain value over time.
If you zoom in, you're going to see this drastic movement up and down in its value. But if you zoom out over a long period of time, you still see the movements, the increase and decrease in value of it. However, in general, it tends to go upwards. Investing 80% of the time, it's a mind game. It's psychological. People see their stocks decrease in value and it's like, oh no, I want to get out of the game. I want to sell. But that's the opposite of what you want to do, right? You want to buy low, sell high. And if it's decreasing, that's not the time you want to sell. You want to give it time, let it increase.
Yeah, a good example for that could be like Microsoft Corp. If you go to 1990s, it says that the stocks is like $1. But if you go to like the present, right now it's like 346. So that's a big marginal percentage win, the long run, not the short run.
And if we're looking at the 90s till now, that's only, most people work 30, 40 years. So if you just leave it alone and let it do its thing, more than likely you'll end up on the better end of things. Then we have bonds. So this is another one that was mentioned as a commonly known one.
Bonds are like loans that you can give to the government or corporation. It's the opposite of a credit card. Instead of you borrowing money from any organization is borrowing money from you. The company will pay them back with interest. It's less risky than a stock. because it's considered like a secure type of investment. Also, the interest is going to be less than other types of investments.
Our next one is mutual funds.
Mutual funds provide instant diversification by investing in variety of securities, even with a small investment. It's like buying the variety pack. You can buy or sell shares at the end of each trading day. You can choose to have it actively managed by a professional, which can save you time and effort because the fund manager researches and decides which investments is good to make, or you could passively manage it by mutual funds, referred as an index fund, which means the fund just simply aims to match the performance of a particular market index, like the S&P 500.
Like Victor said, a mutual fund provides instant diversification. Well, a mutual fund is many different things in one fund that you're investing in. So if one isn't doing well, the other one is, it's going to make up for that other loss. Next is ETFs, or exchange traded funds.
So it's a hybrid between stocks and mutual funds, and then give you the best of both worlds. First off, ETFs lets you diversify your investment by tracking a specific index or a certain area of the market. So instead of putting all your eggs in one basket, you get a piece of many different companies or sectors all at once, just like a mutual fund does. ETFs trade on the stock exchange just like individual stocks do. This means you can buy and sell shares of the ETFs throughout the trading days, just like a stock.
Victor, are there things that our listeners should be aware of with ETFs?
Well, yeah, I mean, ETFs come with a risk, just like how stocks, bonds.
Another thing to be aware of, because ETFs you can trade throughout the day like you can with stocks, when you do the buying and selling, that creates a taxable event.
Yeah, actually I have a question, Tara. I would like to know more about why is ETFs a better option than just buy different stocks?
It's not necessarily a better option. It's just another option. ETFs are automatically diversified because that's the part of the mutual fund that it's like, and lower fees. Our final one that we're going to talk about today is something called an annuity.
Well, an annuity, an amount of money to a company, and they will give you back that amount of money split in different payments after your retirement age.
These are offered by insurance companies. Annuities are often used alongside other retirement savings accounts.
So something to be aware of is that annuities can be a bit tricky to understand. They can come with a lot of complicated terms and conditions. They tend to have high fees, which means you might have to pay a good amount of money to just keep an annuity. It's always good to research on who has the better deals and if it's worth it in the long run.
Victor and Natalia, do you have any final thoughts about types of investment?
We have been telling that investments are for once you retire, you will get that money back. And I think because of that, many students feel that that's not a necessity right now, and many students feel like, no, why should I care about that right now? It's not part of my budget in this moment, especially because we have many other concerns. But I will say that even if you're not thinking about investing right now, it's important to be aware of all of these opportunities, because in the future you might want, and you will need to consider all of these factors.
So when thinking about investment types, just know this in simple terms. If it has high interest, that means the risk is, high. And if it's low, then it's safe. So for those of you that are like thinking of doing stocks or something that you'll get more money into it, just know the risk factor and just research beforehand, because a lot of people, because social media, make investment types seem like this really get rich quick type of way, but it's not that. It's more of a long-term thing. So
yeah, both of you make a really good point. Investing is, for the most part, it's for the long term. How it works really well is you give time for that compounding interest to grow. At first, it's really, really, really slow, right? It's more like, well, the money you're putting into that investment is making it grow than the compounding interest is. Typically, after 10 years, you'll start to notice that, hey, my money's working a little bit harder than I have to. That compound interest eventually will do more work with your money than you can. That concludes today's episode of College Cash Corner. We want to express our gratitude for tuning in to this episode. Before we wrap up, we would like to emphasize that the financial literacy team is here to provide support and guidance to MCC students on their journey to improving and maintaining their financial knowledge. You can find us on MCC's financial aid website by clicking on the financial literacy section on the left side. There you can schedule a one-on-one appointment with us, access a free cash course account, stay informed about upcoming workshops and events, and explore additional financial resources that are available to you. Until we meet again, remember to be mindful and make wise decisions when it comes to your finances. Take care.